Well, we're so glad you can join us here on a Monday. I'm Marlon Bowling with you, your tour guide to the ag commodity trade, and I'm joined by none other than Brian Hoops, the president of Midwest Market Solutions, and he's in Springfield, Missouri. Brian, right off the top, we have some new information that came out from USDA. We had some export sales over the weekend. This is what they call their flash sales, and it was a sale of soybeans this time, kind of back to the old regular amount of 132,000 tons, and it was sold to China. So there you go. We're off to at least a decent start, I guess, here on the trade this week. We'll see if it has anything whatsoever to do with our overnight trade. Of course, that all shut down before we got this announcement just a couple of moments ago. Let's review what we did last night. On the corn market, with our quotes provided by Bar Chart, you know, it was very quiet early this morning. When I got up to go to work, everything on the December corn was about flat. And now I see where we finished up the Globex trade 3 3/4 higher at 572. That would be a couple of pennies off of its overnight high. Now on the soybean market overnight, it was kind of dragging its feet a little bit. We had November down 2 1/4 at 1233.5, and gosh, by the way, we're in November now, so happy November, Brian. January, 3 1/2 lower at 1246 per bushel. Now, this is, again, before this export sales announcement came out. Brian, let me ask you this. Is most of the volume now on the January contract, or is it even out in March?
Yeah, most of the contract volume is traded in January at this point in time. All the elevator business has rolled over to January as their spot month for soybeans. And so you get most of your open interest in January. Eventually, it'll roll over just like every month that we have. But, trade will be looking at the end of this month, forecasting the next 30 days, trying to take deliverable receipts of the November contract as we go into first notice day for that contract month. That'll be going off here in the middle of the month. So we've heard some deliveries. We heard some private sales overnight. So, soybean market here wants to try and find some footing, but with the supply and demand report coming out next week, it's going to be hard to maintain or sustain any type of gains for the soy complex as we expect to see increased yields and increased ending stocks in the report.
Well, now let's look at this wheat market overnight. That was kind of an interesting animal. We'll start with our Chicago wheat. We had that December contract last night, 9 1/4 higher at 782 per bushel. That was some pretty sizable gains for that wheat market. And if you look at Kansas City wheat last night, same December contract, we were up 6 1/2 at 792 1/4 last night. Now you get to that Minneapolis spring wheat trade, and that tends to have bigger moves off and on. And that December contract was actually 15 1/4 higher at 1067 1/2, got as high as 1069. Brian, what's driving the wheat market higher over the weekend?
Yeah, it seemed like it was just a week or so ago we were talking about the wheat knocking on the door of $10 a bushel. Now spring wheat may march towards $11 a bushel. We have very tight supplies. We're not going to replenish those supplies until next year sometime. Most of the wheat that's grown in the worldwide basis is going to be either exported or consumed in breads, and this milling wheat that we grow in the spring wheat belt, not widely grown on a worldwide basis. It's grown in the U.S. and Northern Plains and Canada, and with the drought that they've had, we're in a rationing phase, and I think you continue to see this type of market action where you move higher for most of the month over the next several months into the winter period.
And also, look at the oats market at it again. December oats, 14 1/4 cents higher at 744. And again, I'll remind you that December corn was only 572. And now you have the oats at 744. Crazy spreads between the corn and oats here this year. Cotton market overnight up 283 points. Look at it go. December up at 117.68. Got as high as $1.19 overnight. We'll come back and take a look at our livestock sector when we return after this. Let's go back to Brian Hoops of Midwest Market Solutions and find out what he thinks about our livestock trade here today. A quick review of where we wrapped up last week here, Brian, and we'll take a look at what it means for today. If you recall, when we finished the trade last week, we had December live cattle down over $1.05 weaker at the end of the session on Friday. And on the feeder cattle market, you had the November down $1.07 at 156.57 in January and March. We're both down $1.45. And then on the lean hogs, as we headed into the weekend, we actually had December 87 higher, and February was up $1.47 at 78.67. Now, the cash cattle trade on the livestock summary last week, Brian, I believe it was kind of hovering in a range of 124 to 126. The dress basis cattle in a range of 196 to 200. This is the overall ranges pretty much from last week. So now, do you think we're going to be able to improve on that this week or not?
Yeah, that's what the trade's going to try and determine here early part of this week as we assess the show list numbers. But those cash trade that you have reflected $2 to $3 better than the prior week. So certainly weakness in our futures last week, not tied to the cash markets. That should be a supportive feature as we come out of the gates here this morning. I think you saw the cattle market sell off late in the week, still closing higher on a live cattle basis for the week, having weekly closes on a higher note. And I think you will start to see this market stabilize and probably see some buying interest come in as we expect maybe the numbers to tighten up even further going into the month of November. So look for the futures, maybe have a little lower opening, but find some buying interest. Of course, the feeder cattle will struggle with the corn market moving higher. It did last week and probably will to start this week. So you could have a real spread variance with live cattle trying to rally and the feeder cattle market under some pressure.
Brian, I just wanted to call attention for our viewers and listeners out there of some new information that came out from the CME this morning. And they have revised their trading limits on their grain trades in this case here. Wanted to read these off for folks. I just tore this off the printer as I was coming in here, but corn is now 35 cents for their normal limit. The soybeans are now 90 cents for their limit. We have Chicago and Kansas City wheat 50 cents and Minneapolis wheat 60 cents. So is it higher and lower depending on which one you're looking at here?
Right. The CME will adjust these trading limits every 6 months. Could be higher, could be lower, depending upon the commodity. And I think what they really need to focus on, instead of worrying about trading limits that we hardly ever touch, and especially in the grain markets, is looking at the margin requirements for trading futures. They had raised those requirements during the spring timeframe when things got real volatile and into the summer months when they got extremely volatile, and they've not lowered those requirements again now that the futures markets don't have those summer weather type swings. So it's time to lower the margin requirements, get some open interest, more volume being traded back into these markets, and they can do that by lowering margin requirements. They could virtually cut corn, soybeans, and possibly wheat in half and increase the volume considerably.
Interesting stuff. Thanks for pointing that out. Brian Hoops, Midwest Market Solutions. Tammy, we're about ready to get rocking and rolling this morning.